Hi and welcome to Swiss Codes Daily Market Talk. It's Monday, March 3rd. The meeting between Trump and Zelensky ended in a clash. The European leaders then stepped in to show their support with a so-called coalition of the willing. The euro rebounded and the European futures traded in the positive in the early hours of the new trading week. On the individual front, while the Chinese bubble tea giant Mixue had a strong IPO in Hong Kong. So the geopolitical developments since we last talked weren't, encouraging to say the least. The meeting between the US President Donald Trump and Ukrainian President Volodymyr Zelensky didn't really go according to the plan. There has been no mineral deal, and the whole thing just ended up in a clash instead. Now, happily, Zelensky's gathering with the UK PM Starmer was better than that. Starmer actually called the European leaders for a coalition of the willing to provide Ukraine with military support and safety guarantees that they need most right now. The French President Emmanuel Macron said a bit later than that they will be seeking a 1-month truce as well. So if we summarize all that, the relationship between the two continents has only gotten worse over the past days, and oil rose in the early hours of trading in Asia on worry that the clash between Donald Trump and Zelensky and other European leaders eventually would take longer to lead to a permanent peace. But the selling pressure actually appears to be stronger than the geopolitical risk perception among the investor community, as the latest data released last Friday in the US actually fueled growth concerns for the US economy, and I will come back to that very shortly, but let me first finish with the Ukrainian situation, if you will. So the euro dollar actually kicked off the new week of trading on a positive note after having slipped below its 50-day moving average on Friday. The so-called coalition of the willing would obviously boost defense spending for the European countries and could lead to faster growth in the short run and a further advance than otherwise in technology. That could also benefit to the larger economy in the medium to long run. But obviously, higher spending also means higher borrowing as well, and we will likely see that the higher borrowing prospects push the European yields higher. The latter, on the other hand, doesn't seem to impact mood in early trading because the European Central Bank is still there to cut the interest rate. So the European futures point at an optimistic start to the week despite discouraging geopolitical developments, with DAX futures actually leading gains at the time I'm talking here with almost 1% advance this morning. Gold, on the other hand, has given back early session gains, while the US dollar is softer across the board and even against the loonie, although the US is now supposed to go ahead with 25% tariffs on all Mexican and Canadian imports, while levies on Chinese products would be doubled to 20%. Voila! Have a nice week, guys. So, the Chinese and Hong Kong equities actually kicked off the new week on a negative note, and that despite a stronger than expected Caixin data this morning that suggested that the manufacturing activity in China actually grew, and it grew faster than expected by analysts in February. And moreover, Chinese bubble tea giant Mixue made a strong debut in Hong Kong trading this morning, and that's also something to take your mind off the complicated geopolitics of the moment for a moment. Now, coming back on the economic data front. Friday's news was quite bitter and sweet, to say the least. The core PCE index in the US, which is the Fed's favorite gauge of inflation, right? So that metric came in line with expectations. But the combination of higher than expected personal income, but lower than expected and unexpectedly negative spending growth in January actually raised a few eyebrows and raised the worries regarding the US growth prospects. On top of it, Atlanta Fed's GDP now forecasts tanked to minus 1.5% Yes, negative 1.5% from above 2% printed previously. So that means that US growth expectations are deteriorating right now, and they are deteriorating fast. The latter could eventually boost the dovish Federal Reserve expectations, which would be an encouraging, a positive development for risk appetite. You know, the bad news is good news thing, but for the Fed to be able to go ahead with further support to the economy, well, it must make sure that inflation is under control. And with tariffs that are expected to come in play as early as this month, well, controlling inflation for the Fed won't be a walk in the park. Anyway, this week, the market and investors will be focusing on January employment numbers from the US. A consensus of analysts' expectations on the latest Bloomberg survey actually suggests that the US economy may have added around 156,000 new non-farm jobs, and the data could also print slightly slower wages growth. Investors will also be looking at the impact, of course, of this mass firings at the federal government offices in the coming months. So the employment numbers from the US can come with surprises, and they won't be necessarily good surprises on horizon. Again, soft-looking economic data is good for boosting the Federal Reserve dose, pushing the yields lower and improving sentiment in risk assets. But if inflation doesn't allow, the Fed will be also sitting and watching the economic growth crumble without doing, well, much about it. Here in Europe, well, the latest developments are perceived with some optimism among investors, as I said before, and that's on hope that this clash and this growing tensions with the US will finally awaken the sleeping European economies, shift focus from the financial control to more government spending, and without asking too many questions on whether the extra spending for security is justified, because it obviously is. So Europe needs defense, as the US is now pulling back its military support, and the war in Ukraine is still ongoing. So that gives a further conviction in Europe to even the most army skeptic layers of the population. Because note also that in the past, war and military spending haven't been just bad for economy. They have often accelerated technology advances, on the contrary, and served to the broader economy in the medium to long run. And if the military ambitions is the only thing that could federate political spectrum and encourage to get better, well, be it. It is what it is, right? On the trade front, generally, the next step in Donald Trump's tariff threats is obviously the actual implementation, with levies set to increase. So the latter will certainly have a negative impact on growth prospects on, both sides of the Atlantic Ocean and in China, everyone who is concerned, and call for a decent support from the European Central Bank in Europe to the underlying economies. But here as well, the inflation's trajectory is obviously important to assess the extent to which the European Central Bank could ease the financial conditions in the Eurozone to boost growth. Now, the CPI updates for February that were released last week actually pointed at a mixed picture across the major Eurozone countries, but the aggregate CPI update, which is due this morning in Europe, is expected to print a softening headline and core inflation in February. If that's the case, if inflation allows, the impact on the euro of soft inflation is not necessarily certain, because soft inflation numbers do actually back the expectation of a more dovish European Central Bank stance and could weigh on the euro's valuation, but the geopolitical tensions of the moment boost growth prospects for Europe, and the idea that monetary and fiscal support would actually lead to a stronger than otherwise growth across the European countries, that could be quite positive for the euro's outlook. So pick your side. I actually believe that the combination of deteriorating growth prospects for the US and improved growth prospects for Europe, even if it's not for the best reasons, could lead the euro-dollar to regain confidence and eventually appreciate sustainably beyond the 106 mark, which is the major 38.2% Fibonacci retracement on September to January Trump sell-off, and could eventually reverse the Trump-led bearish trend in the euro-dollar. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.